Hey everyone, welcome back to the channel. Today, we're diving into one of the most popular retirement savings plans in the United States, the 401k. Whether you're just starting your first job or you've been working for years, understanding how a 401k works can make a huge difference in your retirement savings. So stick around to learn what a 401k is, how it benefits you, and how you can make the most out of it. This video covers a lot, so feel free to skip ahead to the sections you need using the chapter timestamps. No need to watch it all in one go. Let's start with the basics. What is a 401k? The name 401k comes from the section of the U.S. Internal Revenue Code where the Internal Revenue Service, IRS, first introduced this plan to encourage Americans to save for retirement. A 401k is a tax-advantaged retirement savings plan offered by many employers in the U.S. It allows you to contribute a portion of your paycheck before taxes into an investment account, which can then grow over time. The idea is to save for retirement while benefiting from potential tax savings and employer contributions. Here's how it works. Each pay period, a portion of your paycheck, let's say 5%, is automatically set aside and added to your 401k account before taxes are taken out. This reduces your taxable income, so you're paying less in taxes today. And here's the sweet part. Many employers will match some or all of your contributions, which is essentially free money. However, these employer contributions might come with strings attached, like a vesting schedule, which determines how long you need to stay with the company to keep those funds. Once you reach retirement, you can start withdrawing your savings. But remember, that's when taxes kick in on both your contributions and any earnings your account has made along the way. It's a great option if you think you'll be in a lower tax bracket when you retire, with the added bonus of immediate tax savings and employer support. One of the biggest perks of a 401k is its tax advantages. Your contributions are tax-deferred, which means you don't pay income tax on the money you put into your account until you withdraw it in retirement. This can lower your taxable income today, potentially putting you in a lower tax bracket. Imagine Jack lives in San Francisco and earns $150,000 annually. If Jack contributes the maximum allowed amount of $23,000 to his 401k in 2024, his taxable income drops from $150,000 to $127,000. As a result of lowering his taxable income, Jack unlocks significant tax savings. Jack saves $5,520 on federal taxes. He also saves $2,139 on California state taxes. Combined, Jack saves $7,659 in taxes for the year. This example shows how contributing to a 401k not only helps with retirement savings, but also reduces the tax burden today. And here's the cherry on top. Any growth in your 401k, whether from interest, dividends, or capital gains, is also tax-deferred. But did you know there's also something called a Roth 401k? It works a little differently. With a Roth 401k, unlike the traditional 401k, contributions to a Roth 401k are made after taxes have already been taken out of your paycheck. That means there's no immediate tax break, but here's the payoff. When you retire, all withdrawals, including any investment growth, are completely tax-free. This can be a game changer, especially if you expect to be in a higher tax bracket when you retire. Just like the traditional 401k, many employers offer matching contributions to your Roth 401k. But here's the catch. While your personal contributions grow tax-free, any employer contributions to your Roth 401k and the growth from those contributions will still be taxed as ordinary income when you withdraw them. Even though your employer is contributing to the same account, those funds are treated differently by the IRS. So, which option is right for you? It depends on whether you want the tax savings now with a traditional 401k or prefer tax-free income during retirement with a Roth 401k. So how much can you contribute? The annual contribution limits are set by the IRS and typically increase based on inflation adjustments. In 2023 and 2024, the limit rose substantially to help savers keep pace with rising costs. In 2024, the IRS allows you to contribute up to $23,000 per year to your 401k. So, what happens if you don't contribute the full limit to your 401k in a year? Unfortunately, the IRS doesn't let you roll over unused contributions to the next tax year. Every January 1st, the limit resets, and you can only contribute up to that year's maximum. If you miss out, that tax-deferred saving opportunity is gone for good, so it's a use-it-or-lose-it situation. Now, if you're 50 or older, there's good news. You can take advantage of catch-up contributions, which encourages retirement savings among older workers. It allows you to contribute more than the standard limit. For example, in 2024, the base limit is $23,000. But with a $7,500 catch-up option, you could contribute up to $30,500. Let's talk about vesting. Employer contributions might not be yours to keep immediately. They're often subject to a vesting schedule, which means you need to stay with your employer for a certain number of years before you can keep their matching contributions. Your contributions, however, are always 100% yours. One key takeaway: always aim to contribute enough to take full advantage of the employer match. It's essentially free money. For example, if your employer offers a 50% match on the first 6% of your salary and you make $100,000 a year, contributing 6%, $6,000 will earn you an additional $3,000 in free money from your employer. If you contribute less than that, you're leaving money on the table. Now, when it comes to a 401k, you usually get a menu of investment options to choose from. In most cases, the menu of investment options is provided by the employer, but it's designed and managed by the 401k plan provider. Employers typically partner with financial institutions like Vanguard, Fidelity, or Charles Schwab to offer these plans. The plan provider curates the investment options, which often include a range of target date funds, index funds, mutual funds, and sometimes even company stock. Target date funds, for example, are designed to grow more conservative as you get closer to the retirement age. It's essential to pick investments that align with your risk tolerance and time horizon. Now, let's cover an important rule. You should avoid touching your 401k before retirement. If you withdraw funds before age 59.5, you'll usually have to pay income tax on the withdrawal plus a 10% early withdrawal penalty. There are exceptions, but it's generally a good idea to leave your 401k alone and let it grow for your golden years. While it's generally advised to leave your 401k untouched until retirement, there are specific exceptions where you can avoid the 10% early withdrawal penalty. Here are some key scenarios. Medical expenses. If you have unreimbursed medical expenses exceeding 7.5% of your adjusted gross income, you may qualify for a penalty-free withdrawal. Disability. If you become permanently disabled, you can access your 401k without the early withdrawal penalty. Birth or adoption. Since 2020, you can withdraw up to $5,000 per child, penalty-free within 1 year of the birth or adoption. Separation from service, age 55 rule. If you leave your job during or after the year you turn 55, or 50 for public safety employees, you can withdraw from your 401k without a penalty. Substantially equal periodic payments. This method allows you to withdraw funds in equal installments over time without incurring penalties, even if you're under 59.5. However, it requires careful planning and must follow strict IRS rules. Any changes to the payment schedule can trigger penalties, so it's important to fully understand the process. This scenario deserves a dedicated video for further exploration. These are some common exceptions, but there are additional ways to avoid penalties, especially through rolling over funds from a 401k into an IRA. What does it mean to roll over funds into an IRA? Let's take a moment to talk about IRAs, individual retirement accounts. These are another type of retirement savings vehicle that offer some unique benefits. While 401k accounts are typically provided by employers, IRAs are accounts you open on your own, giving you more flexibility with investments and withdrawals. So what does rolling over funds from a 401k into an IRA mean? Simply put, it's the process of transferring your money from a 401k into an IRA, usually without paying any taxes or penalties, as long as you follow IRS rules. Rolling your 401k into an IRA opens up additional exceptions to early withdrawal penalties. For example, first-time home purchase. You can withdraw up to $10,000 penalty-free from an IRA to buy your first home. Higher education expenses. Although 401k plans don't offer penalty-free withdrawals for education, IRAs allow you to withdraw funds penalty-free for qualified education expenses, such as tuition, books. Once you hit age 73, you'll be required to start taking required minimum distributions from your 401k. The IRS mandates this, so you can't leave your retirement savings untaxed forever. Be sure to factor these withdrawals into your retirement planning so you can manage taxes effectively. So, how do you make the most of your 401k? First, always contribute enough to get the full employer match. That's essentially free money. Second, review your investments regularly to make sure they're still aligned with your goals. And finally, as your income grows over time, consider increasing your contributions. The earlier and more you save, the more time your money has to grow. Step 1. Check if your employer offers a 401k plan. Most companies provide this option, but it's essential to confirm. If they do, great, you're already on your way. If not, consider other retirement savings options like an IRA. Step 2. Read the plan documents. This may seem boring, but it's crucial to understand the details, like contribution limits, employer matches, and investment options. Knowledge is power when it comes to your finances. Step 3. Fill out the enrollment form. You'll need to provide basic personal information such as your name, social security number, and contact details. Don't worry, it's a straightforward process. Step 4. Choose your investments. Most 401k plans offer a variety of options, from stocks to bonds to target date funds. Think about your risk tolerance and retirement goals when making your choices. And remember, you can always adjust your investments as you go. Step 5. Start contributing. Decide how much of your paycheck you want to contribute. If your employer offers a match, try to contribute at least enough to get that full match. It's essentially free money. And there you have it. Opening a 401k account is a fantastic step toward securing your financial future. Remember, the earlier you start saving, the more time your money has to grow. To sum it up, a 401k is one of the most powerful tools for building your retirement savings. The tax advantages, employer contributions, and potential for long-term growth make it an essential part of any retirement plan. So if you haven't already, start contributing today. Thanks for tuning in, and as always, don't forget to like, subscribe, and hit the notification bell for more financial tips and strategies. See you in the next video.